They rolled the shorts. $50 billion worth, not closed, not covered. Rolled forward, extended into future contracts. Bullion banks that were supposed to let their short positions expire quietly, instead push them into next month, and the month after. Buying time, delaying settlement, postponing the moment when paper contracts have to convert to physical silver they don't have. And while they extend, defer, delay, physical silver supply is tightening. Vaults are draining. Delivery is becoming harder. The pressure they're trying to avoid is compounding. And if you think rolling shorts is a sign of strength, you need to understand what you're actually witnessing. This is desperation disguised as strategy, and the banks that are rolling are running out of time before the strategy collapses. Short positions were expected to expire this month. Standard process. Contracts come due. Banks that sold short either deliver physical silver or buy back their positions. The system clears. The cycle continues. Except the banks didn't deliver, didn't close. They rolled, aggressively. $50 billion in notional exposure pushed forward, extended, kicked down the road. And the reason is simple. They can't deliver the physical, can't source enough silver to satisfy their obligations, can't cover their shorts without driving prices up and revealing how exposed they actually are. So they roll and pay the cost and hope that somehow, next month, the situation improves. This shouldn't be happening. When physical supply tightens, shorts should shrink. That's basic market mechanics. If you're short a commodity and that commodity becomes scarce, you cover your position. You buy back. You reduce exposure. You don't extend it. You don't roll it forward into an environment where covering will be even harder. But the banks are doing exactly that, rolling massive short positions into a market where physical silver is becoming scarcer every week, where vault inventory is dropping, where delivery is straining. They're adding risk instead of reducing it, extending exposure instead of closing it. And that only happens for one reason. Because closing is worse than rolling. Because covering now would break something they're not ready to break. The timing exposes the trap. Physical silver supply tightened at exactly the same time contracts were expiring. Not coincidence, not random. Someone positioned for this. Someone accumulated physical silver while banks were heavily short, drained vaults while contracts were coming due, created conditions where banks either deliver physical they don't have or roll forward and hope supply loosens. And the banks chose roll, chose to extend, chose to compound their exposure rather than admit they can't deliver, which means the physical supply situation is worse than anyone is saying publicly. Worse than the banks can handle. Worse than rolling can actually solve. This keeps happening. Every contract expiration shows the same pattern. Banks roll their shorts, push exposure forward, pay the rollover costs, and the short positions don't shrink. They grow. Because they're not just rolling existing shorts, they're adding new ones, selling more paper silver into a market that's running out of physical silver. And every new short they add makes the eventual squeeze worse, makes the delivery failure more certain, makes the moment when rolling stops working more catastrophic. The rollover bought time, but increased risk. That's the fundamental problem. Rolling shorts isn't neutral. It's not just pushing the problem to next month. It's making the problem bigger. Because physical supply keeps tightening while the shorts keep extending. Because vault inventory keeps dropping while exposure keeps growing. Because every month they roll is a month more accumulation happens, more physical leaves the system, more pressure builds. And the banks that are rolling $50 billion today will have to roll $60 billion next month, $70 billion the month after, until the math becomes impossible and rolling stops being an option. This benefits someone. Physical holders are winning. Anyone who took delivery before the rollover. Anyone sitting on allocated silver. anyone who owns real metal instead of paper contracts. They're watching banks extend short positions in a tightening market and calculating their leverage. Because when shorts can't be covered, when banks can't deliver physical, can't close positions, can only roll forward, physical silver reprices, not gradually, violently. The gap between paper price and physical availability becomes undeniable, and the holders of physical metal control the supply banks desperately need. The sophisticated accumulators positioned for this exact scenario. They bought physical when banks were aggressively shorting. They took delivery when vault inventory was higher. They removed silver from the system when removal was easy. And now they're holding. Watching banks roll shorts they can't cover. Watching vault inventory deplete. Watching the squeeze tighten. They're not selling. Not returning metal to the system. They're waiting for the moment when banks can't roll anymore. When delivery failure becomes public. When paper silver and physical silver become two completely different assets with completely different prices. This hurts you. If you're holding paper silver, ETFs, futures, unallocated accounts, you own claims on metal that banks are too exposed to deliver. If you assume your paper will convert to physical whenever you want, you're assuming banks can source silver they're currently proving they can't source by rolling instead of covering. If you think the banks are in control because they're managing their positions, you're misunderstanding what rolling actually means. It means they're trapped. It means they can't exit. It means they're hoping the problem solves itself before they're forced to admit it can't be solved. Here's the mechanism destroying you. Banks sold short silver they didn't own. That's normal. That's how futures markets work. You sell short betting the price will fall, or you'll be able to source physical if delivery is demanded. But someone demanded delivery at scale. Someone is draining physical supply, and the banks that are short can't source enough metal to deliver without spiking prices and triggering margin calls on their short positions. So they roll. They extend their shorts into future months. They pay rollover costs. They hope demand decreases. But demand isn't decreasing. Physical accumulation is accelerating, and every month they roll is a month they dig the hole deeper. Pressure is compounding instead of releasing. That's the tell. Rolling shorts should provide relief, should give banks time to source metal, reduce exposure, manage positions. But the pressure is increasing. Physical premiums are rising. Vault inventory is falling. Delivery delays are extending. Every metric that should improve after a rollover is deteriorating, which means rolling isn't solving anything. It's just postponing the moment when the banks have to admit they can't deliver on their obligations, and postponement doesn't make that moment less severe. It makes it more explosive. But banks can't source replacement silver fast enough. Mining output is allocated. Industrial demand is constant. Existing holders aren't selling. There's no flood of supply waiting to refill vaults and let banks cover shorts comfortably. The silver that's leaving the system is gone. The metal that accumulators are holding isn't returning. And the banks that need to buy silver to close $50 billion in short positions are discovering there isn't $50 billion worth of deliverable silver available to buy. Not at current prices. Maybe not at any price they can afford without destroying their balance sheets. This won't stop, because the trap is already closed. The banks are already short more silver than they can deliver. The physical supply is already tight enough that covering would spike prices. The accumulators are already holding enough physical to dictate terms. The only question is timing. How long can banks keep rolling? How many more months can they extend exposure? How much more pressure can compound before something breaks? And when it breaks, when a bank can't roll anymore, when delivery failure goes public, when paper silver stops converting to physical, everyone holding paper discovers simultaneously that their silver doesn't exist in deliverable form. The next contract expiration forces delivery or exposure. More shorts are rolling toward maturity. More contracts are coming due. And the banks that just rolled $50 billion forward have to decide again. Roll further, cover, default? None of the options are good. Rolling increases exposure. Covering spikes prices. Defaulting reveals the fraud. So they'll probably roll again, extend again, compound the pressure again, until the month when rolling stops being possible. When counterparties refuse, when margin requirements make rolling unaffordable, when physical supply is so tight that any attempt to cover triggers the squeeze they've been trying to avoid. This looks like a deliberate delay before an unavoidable squeeze. The banks know they're trapped. They know rolling doesn't solve the underlying problem. They know physical supply is tightening while their short exposure grows. But they're betting on time, betting that something changes, that physical supply loosens, that accumulators start selling, that demand decreases, that somehow the math that doesn't work today will work in the future. But nothing is changing. Supply is getting tighter. Accumulators are holding stronger. Pressure is building higher. And every month they roll is a month closer to the squeeze becoming undeniable. You're holding paper silver in a market where the banks that are supposed to make that paper convertible are rolling $50 billion in shorts instead of covering them. Where physical supply is tight enough that delivery is impossible at scale. Where the gap between paper claims and deliverable metal is widening every single day. And you're positioned as if your paper is equivalent to physical. As if conversion will happen smoothly. As if the banks rolling shorts is normal market activity instead of distress signaling disguised as strategy. The rollover costs are mounting. Every time banks extend their shorts, they pay fees, interest, time decay. The costs of maintaining massive short positions in a tightening market compound. And those costs come from somewhere. From bank profitability, from capital reserves, from the cushion that's supposed to absorb losses. And as the costs mount, as the positions extend, as the pressure builds, the bank's ability to sustain this game weakens. Their balance sheets strain. Their risk managers get nervous. Their counterparties demand more collateral. And the moment they can't meet those demands, the rolling stops. And if rolling stops, covering starts. And if covering starts at scale, the price explosion is immediate. The physical holders are tightening the vice. Every ounce they remove from the system is an ounce banks need to cover shorts. Every delivery they take is pressure banks can't release. Every month they hold instead of selling is a month banks have to roll instead of cover. They're not passive investors. They're active squeezers. They position specifically to trap banks that are massively short. And the banks that are rolling $50 billion in exposure are proving the trap is working, proving they can't exit, proving the physical supply they need to cover doesn't exist at prices they can afford. Shorts should shrink when supply tightens. That's how markets are supposed to work. That's how risk management works. That's how banks that understand they're exposed should behave. But these shorts are growing, extending, rolling forward into worse and worse conditions, which means the banks aren't managing risk. They're trapped by it. They can't shrink positions without admitting defeat, can't cover without triggering catastrophic losses, can't deliver without sourcing physical that isn't available. So they roll and extend and hope and compound their exposure every single month. You're watching bullion banks demonstrate in real time that they're short silver they can't deliver. Not through admission, through action, through rolling instead of covering, through extending instead of closing, through paying costs to defer settlement rather than settling. Every rollover is evidence. Every extension is proof. Every month they push exposure forward is confirmation that the physical silver backing their short positions doesn't exist in deliverable form. The next expiration is approaching, more contracts maturing, more decisions required, and the banks that just rolled will have to roll again. In a market that's tighter, with vaults that are emptier, with accumulators that are holding firmer. The math is getting worse, the options are narrowing. The moment when rolling stops being possible is getting closer. And when that moment arrives, when a major bank can't roll, can't cover, can't deliver, the squeeze that's been building for months becomes public, becomes undeniable, becomes the repricing that rewards physical holders and destroys paper claims. The $50 billion they just rolled isn't relief, it's accumulation. Accumulation of pressure, of risk, of exposure that grows larger and more dangerous every month. The banks aren't escaping, they're digging deeper. And every month they dig, the hole gets darker. The exit gets farther. The squeeze gets tighter. Until the moment when there is no next month. When rolling stops being an option, when the shorts they've been extending for months all come due at once in a market with no physical supply to cover them. And that moment is coming, not in years, in months, possibly weeks. Because the vault inventory that's draining doesn't replenish, the physical supply that's tightening doesn't loosen, and the banks that are rolling $50 billion in shorts are running out of road to kick the can down.